That's my recording now. And usually when I record and I don't do the transcript or anything like that, it takes a while for me to publish it. But if the transcript is there, I can summarize it quickly.
Yeah.
So I'll ask them to do make me some kind of transcript. Okay. All right. So who? Oh, I'm gonna get Andrea to introduce you because you guys been talking. So she must have some idea who you are at this point and what you do. So let's
Too
get
early
ready.
for this.
Oh, you know you have to be awake around me always. So listen, we're ready to get started. Andrew, thanks for being here. Appreciate you being here, and this is gonna be exciting. Even though accountants are generally, should I say that, boring, but given the time that we
No,
are
no offense taken.
with tariff and all that kind of stuff, I think this is an exciting field to be in. So, Andrea, introduce Andrea for me officially, please.
Well, luckily, I have the Bang group right in front of me, and there's a beautiful description about our guest speaker today, Andrew Mahorn, who is an amazing tax advisor and business consultant from LMN Accounting Solutions. And he's here with us today to present about tax tips and timelines for business owners. And of course, we're in this time where it's tax season. And if you're anything like me, where I am stressed about bookkeeping and accounting, this is the perfect time for you to join us this morning to learn all about it. And I'm so excited to introduce Andrew, who's going to go walk us through it. And if you are troubled by the tariffs and all that, you're in for a treat for today. So without further ado, Andrew.
Good morning, everybody. Thank you. Thank you, Andrea, for the great introduction. Um, can you please confirm that you can see my screen?
Absolutely.
Can.
Perfect. Okay, great. So this is kind of the agenda that I have. We're going to do a little bit of introduction about me, talk about my business. Then we're going to talk about what is tax planning, how we can do it, the importance of reporting, and then we will conclude and open it up for questions. A little bit about me. Um, I am a business consultant with LMN Accounting Solutions. We are a team of 4, sometimes 5, depending on the season. So we do hire a subcontractor during busy seasons. But a little bit about me. I am a drummer. I've been drumming for almost 30 years now. Love basketball, fitness, reading, and real estate. This is just a few of the overarching services that we provide: bookkeeping, accounting, taxation, payroll, sales tax, accounts payable, and receivable. Now, so this is the big question. What is tax planning? Some people like to call it tax provisioning, but what is it? Tax planning is the analysis of a financial situation or plan to ensure that all elements work together to pay the lowest amount of taxes possible. In my line of work, I find it very interesting seeing the different attitudes towards taxes, especially depending on age and background. I find that older people, particularly the boomers, just hate paying taxes. They don't want to give the government anything, and they're very vocal about that. Whereas younger people are more so afraid of the government, particularly immigrants. And so they always want to make sure that they are in line, following the rules, because they don't want any problems with CRA or the government. But just I find that interesting. And so, how do we do tax planning? It is important to review the reports. I recommend at least 3 times a year. This will allow you to predict your income tax early so you can prepare for the tax balance that is owing, or make the necessary adjustments to reduce or eliminate that tax balance owing. And I have a few quotes here that I threw in as we go along. Waiting until spring to start thinking about taxes can cost you thousands of dollars. Um, tax tax season is literally a few months, but tax planning season is literally the rest of the year. So if you're only thinking about taxes during tax season, you may be giving away money to the government. Now, a few considerations to include, and I have some examples of each one, but I won't go into all of them because I know time is limited. But timing of income, at the end of the year, sometimes we can move invoices around, like maybe include invoices in the current year or push some invoices into next year to reduce income for the current tax year. That's more of a year-end calculation. Sometimes timing of purchases and expenses or strategic use of expenses. When it comes to planning and reviewing those reports, I tell people very often that the strategic use of expenses are important. And I'll give a few examples. For example, a real estate agent. Real estate agents, make a lot of money. And so I tell them, one of the examples that I use of spending strategically is if there is a real estate conference in Hawaii, then definitely go. That vacation or real estate conference becomes a business expense rather than a personal expense. And to make it maybe more personal to you in front of me here, Jeff, I know you are into custom guitars and IT. If there's an IT conference in Florida, definitely go to that IT conference and, enjoy yourself. And that becomes a business expense rather than a personal expense. So that's just one way to use strategic expenses. Other things to consider, short-term versus long-term goals. This time of year when I'm making T4s, T5s, or solidifying income for my clients, one of the questions I always ask is if they are applying for a mortgage in the coming years. Because if they are, they will need a high income. And so if they don't need a high income for something like that, then I'll drop their income down to like maybe just $30,000 in dividends. And so they end up paying just $300 in income tax. So it's always good to consider those long-term versus short-term goals when planning your income. Needs versus goals. Cash flow is always important, personal versus corporate, and your age. These are all important things to consider when thinking about your taxes. Now, another quote I love from Robert Kiyosaki here is, it's not how much money you make that matters, but how much you keep and for how long. I love that quote. So how do we do this? How do we plan tax? How do you plan for taxes or tax provision? Oh, why the age? Depending on, there are a number of factors. So I was reading the notes here. Okay, there are a number of factors why we would consider age. For example, if you are over 60 and maybe your OAS has kicked in, depending on the amount of income that you claim, your OAS can be clawed back because the limit for OAS is around $66,000 or $67,000. It changes slightly every year, but if your income is above that, the government will start to give you less for OAS. That's just a small example. But depending on the type of income retirement income that you have, whether it be an RRSP or maybe a retirement income fund, depending on the various forms of income that you have, there are restrictions on how much you can claim. So those are just two examples of why your age is important when it comes to considering tax planning or tax provisioning. But back to individuals. As an individual, there are a number of things to consider, like what type of income, dividends with investments, salary versus commission, or capital gains, which we were talking about, prior to this to the presentation. Sole proprietorship and T4A as a subcontractor, rental income, or home office expenses if you are working from home. So for example, March 3rd was the RSP deadline. And so I had a lot of clients asking me, how much do I need to contribute to my RSP to bring my tax balance down to zero? And so what we basically do is prepare their taxes very early, bring in as many, add up all their income, their various types of income, and really try to create their scenario as detailed as possible and figure out what their tax balance is using all the information. Now, their T4 or T5 may not be ready yet, but we can use the final pay stub from the previous year to actually figure out what their gross was, how much they paid in taxes, and really put together all that information to plan their taxes as best as we can, figure out what their tax balance is, and then plan how much of an RSP contribution they need to make to bring that tax balance down to zero. So that is more so for individuals. That's a very common question the first 2 months of the year. But for business owners, November is a great time to start to pull together those reports and actually figure out what your taxable income is going to be. So that way you can actually make the plans, as we've mentioned in the first few slides there, to A, either prepare for that tax balance, or B, make the necessary adjustments to reduce or eliminate that tax balance. So it's always great to think about taxes throughout the year, not just during tax season. And I need to stress that, because a lot of people, if you're only thinking about tax season, if you're only thinking about taxes during tax season, it's too late. Another thing to consider is that people who have multiple streams of income, they will pretty much always have a tax balance owing. And that is another reason why it is important to start thinking about it before the year ends, so that you can prepare for it or make the necessary adjustments to reduce that tax balance. Seniors, again, talking about age, there are, again, various types of income, but if individuals with a high income or high net worth must consider their various income types and plan to withdraw funds from their business or investments in the most tax efficient manner possible. Again, various factors for that. T5's dividend income is typically taxed much lower than regular payroll. Also, the timing of that income, in conjunction with their other forms of income, if they have other forms of income. So it's always something to consider, particularly with business income or rental income, because rental income does not have any taxes withdrawn from it, or sole proprietorship income doesn't have any taxes withdrawn from it on a regular basis, like you would have if you were regularly employed. For example, T4 income, when you get your pay stub, the taxes are automatically withdrawn from it, so you don't even notice it. But when you move to a sole proprietor and as a business owner, unless you are manually or cognitively paying those taxes to CRA on a regular basis, you're going to have a huge tax balance at the end of the year. And so one of the examples I like to bring up is, think of someone who makes $150,000 a year employed, and then they start their own business and they still maintain that $150,000 a year of profit. They're going to have a tax balance of about $40,000 at the end of the year. And it's going to be a huge hit, because they're moving from a situation where the taxes were automatically withdrawn from their pay versus not being withdrawn from their pay and their income's the same. So it's literally moving from automatically paying taxes to all of a sudden realizing, oh, you have a $30,000, $40,000 tax balance at the end of the year. So these are always things to consider, and that is a huge shock for new business owners. Moving on, the sole proprietorships. So there are a few sole proprietors in the room. So I'll go through this example here. So again, it's important to review your reports at least a few times during the year so that you can prepare for the tax balance. And it's not only income taxes, it's also GST, especially if you're on an annual schedule. So for example, Connie's coaching has a profit of $30,000 after 6 months. Connie expects that the second half of the year will be very similar to the first half, and can predict that she'll have an annual profit of $50K after depreciation and year-end adjustments. $50K of self-employment income will have a tax balance of approximately $7,500. He then has the option to save for this balance or take steps to reduce it with RSP contributions, income sprinkling, or strategic expenses like trips and advertising. So you can tell that halfway through the year, in this example, Connie has profited 30K, and she can already predict the rest of the other half of the year to kind of have a good indication of what her final profit's going to be. Now, it's also important that late payments will incur interest. And so we're all business owners here. So I'm really stressing the importance of bookkeeping. And it's great that Maureen's here, who is a bookkeeper. But it's great to be on top of this. So late tax payments will incur interest. And if there is a tax balance owing of more than $3,000, and this is a big shocker for a few people, but if your tax balance is more than $3,000, CRA will request quarterly installments towards next year. Now, and I see you shaking your head, Dave. Now, this is important because, for example, real estate agents, they may have, tax balance of, 10, 15, 20, 40, $50,000 at the end of the year, which is fine. They've saved for it. But when your tax balance is over 3,000, CRA will actually send you letters, or sometimes send you letters. And I say sometimes, and that's the frustrating part. They will ask you to pay installments towards next year quarterly. So they will actually be expecting a quarterly payment. Now, if they don't receive it, when you do file your taxes, they will actually charge you interest on the installments that they did not receive. Now, that's frustrating because they don't necessarily always send you a warning or a letter asking for those installments, which is frustrating. And I've seen that the hard way. So just want to stress the importance of bookkeeping and taking a close look at those reports throughout the year, not just at the end of the year, so that you can plan for the end of the year. Corporations are no different. And I have another example here. So DB Tech Limited reviews its third quarter reports and observes 600K in profit. It estimates it will finish the year with 750K in profits. DB Tech Limited plans to reduce its tax balance by making a large charitable contribution and expense a nationwide advertising program before the end of the year to bring its profit below $500,000, so that it can take advantage of the small business deduction and lower its corporate taxes. Again, that's just another example of taking a close look at the reports before the year ends and predicting the rest of the year, so that you can kind of have a good idea of what your tax balance will be. And A, you can prepare for it, or B, make the necessary adjustments to reduce or eliminate that tax balance. And again, same note about late payments and installments. Now, I find this tool very cool. Now, we are a mix of sole proprietors and corporations here.
Andrew, did you want to do the questions now as you go, or do you want to do them afterwards? The ones in the chat.
Oh, yes. So I didn't see that pop up here. Is this what you are using from Andrea? I'm just downloading it so I can see it. Maureen, are you taking a picture? I can send this to you if you want. Well, I'm about to explain it, but I'm just looking at the picture that Andrea sent.
Yeah, no, I would like that so I could take a look myself. Thank you.
Okay. Open taxes.
It's basically like, I always hear about, yes, the tax brackets. I actually never looked them up. So then as you're talking, I did. So then I pasted in the chat to see if I did paste the right ones. And then, because even in your example, 2 slides back, you had an example of like in the later half of the year, in that example, if you anticipate, let's say 50K or whatever in your example, then it's 7,000. I'm just like, how do you even calculate that, right? Because, I do have an accountant, but usually, like you said, right, if you want to be predicting it and you want to like save money. And again, for example, for me, like I have an accountant and I have financial advisor. Now I kind of have certain things where I'm like, okay, yeah, like I'm gonna do this and save this and then do that. But then I actually don't know how to calculate it, right? So um what I may be doing may be off or not. I'm not exactly sure. And I'm relying on the other people to kind of
Yeah,
tell
so
me. But
that is an excellent question. And so two things. One, I think I mentioned this to you before, where as a small sole proprietor or a corporation, if you keep all of your business transactions on one or a few bank or credit cards, you can and then export those transactions to Excel, you can actually use that Excel file to create the income statement, which is what your taxes are based on. So if you do that partway through the year, you know what your profit is at that point, and then you can predict what the rest of the year will be like. And you can, there's two ways to do it. Yes, you can kind of type in your income into Google using the tax brackets, or you can try to calculate it. Now, that is somewhat difficult because the provincial and federal tax brackets are different, and they change slightly every year. So you could try that. That's one option. Another way of doing it is gauging your current year based on last year. So, for example, if you did, let's say, 60K last year, and you paid X amount in taxes, you can kind of use that as a gauge of how much you're going to pay in the current year. So there are a few ways to do it, or you could just ask your accountants, like, hey, my sole proprietorship income is this year, 6 months through the 6 months through the year, and I estimate I'm going to double that by the end of the year. You know, if my plan, if everything goes according to plan, what will my tax balance be? And that way you can actually prepare for it. So it's fun. Figuring out the taxes is somewhat difficult. I have software for that that really helps. But yeah, you can ask. There's Google, or you can just do a comparison based on previous years, which is typically the easiest. So yeah, if you have any questions, just kind of jump in. I'll keep the chat open. But I find this tool very cool. It was released pre-pandemic, and I'm just going to.
can you drop
Where to
the
go?
link in the chat because we can't click that link.
Yeah, so I'll explain it right now. Do you see the BDC website here?
Yeah.
Perfect. Okay, so what this is, it's the BDC benchmarking tool. Now, Maureen, you're probably very familiar with the Jiffy codes. Now, what they are doing is, I'll tell you what the Jiffy codes are. The Jiffy codes, and I forget what Jiffy stands for at the moment, but every account, whether it be a revenue account or expense account or balance sheet account, it has a particular code on it that indicates the type of expense. So, for example, office expenses will have a particular code. Travel expenses will have a particular code, and those codes are used on your income tax, whether it be sole proprietor or corporate. So, what BDC did is, and also with those codes, there are industry codes. So, for example, Cliff, what type of work are you in? You're muted.
We've always had a general consulting
Okay.
code that we've used because my wife and I work together in very different industries, but we've always put it under consulting.
Okay, consulting is great. So as an industry code, consulting is one of those codes. And so with this tool, and I'll bring up the site. What they do is they use those Jiffy codes to as a benchmark to figure out where each company is and how they're doing based on industry. So I'll give you an example. Now it's not going to work because I think they took down they stopped updating the site, I think last year, because I delivered the same presentation last year and it worked, but I guess it's not working. So let's say this business has 5 employees, has an annual revenue of say 900,000 and net profit of, let's say, 100,000. And the industry is, let's say construction. And next. And so normally it will actually give you a report as to how your business ranks in with other businesses of the same size and industry. Now you'll see that it says, something's wrong because they took this down or they're not updating it anymore. I don't remember what happened. But if you're ever wondering what CRA does with those Jiffy codes and industry codes, they're actually using it as a benchmark to gauge how each industry is doing. Now, part of the reason for that is they do it for auditing purposes. So if a company, let's say consulting or construction, and has a particular size, CRA uses this tool to gauge their income and expenses. So if their expenses seem ridiculously high in a particular category compared to their peers in the same industry, CRA will send you a letter and say, hey, we noticed your travel expenses or office supplies are high or abnormally high. We want to see what's in that account. So CRA is already using this tool, but BDC made it publicly available for a few years. I found this fascinating when I first came across it in about 2019, but it is no longer working on CRA. So just in case you're wondering what CRA is doing with those Jiffy codes and industry codes, they're using it for a benchmarking tool. Mm-hmm. So going back to presentation. So an insider tip, accounting software is not completely necessary. There's a ton of them out there, FreshBooks, Sage, QuickBooks, Zero, Wave. There's so much out there. You can get into the more enterprise level like NetSuite or Oracle, which are all good. However, they can be very expensive. And so I always say that the cheapest and easiest way, it will require some level of familiarity with Excel, but the background of all those accounting software is Excel. So the same type of reports that you can do in QuickBooks, FreshBooks, Sage, Wave, Oracle, NetSuite, etc., you can do in Excel using the raw data. It will take some knowledge and expertise though. So just to let you know that accounting software isn't completely necessary if you can't afford it, because Excel can do the same thing. And also, so in conclusion, just, what is tax planning? What is tax provisioning? It's the ability to look at a situation and make sure all elements work together to pay the lowest amount of taxes possible. And so I stress the importance of bookkeeping and reviewing the reports at least a few times for the year, so you can either prepare for that tax balance that is going to be owing. That's not only income tax, but also GST or EHT if your payroll is above $1 million. And B, making the necessary adjustments to reduce or eliminate that income tax balance. So this really stresses the importance of bookkeeping and monitoring those reports at least a few times a year. And so if you're not doing that, then you are literally operating blind throughout the year, and doing your taxes early so you know what to expect or have time to make changes is extremely important. So I will open it up for questions here if anybody has any.
I do my own taxes in January, and so that I know how much I owe the government. And so as soon as I get a slip, I automatically put it right in. And I was telling a client yesterday, I says, well, I have a file called CRA and all my slips go in there. So I know exactly where they are. I just don't stick them on a table because then they get lost in all the paper shuffle. So I automatically put it in. And so then I know I haven't got the business part in yet, but all the other slip parts are already in.
I imagine you are extremely organized, which is great.
And also, when it comes to HST, because I tell my clients this, but Andrew, it goes in one ear and out the other ear.
Yeah.
And so anyway, when it comes to HST, say somebody gives me a check for $113. $13 is HST. I automatically move it out of my business account, put it into a savings account because it's held in trust for the government. I'm earning interest on the government's money because I only have to file HST once a year. So, so I do that.
That's also a great idea. Unless the CRA wants those installments quarterly, then you have to give it to them throughout the year.
But I haven't done the 3,000, that requires me to do. And then one other client, she said to me, well, how come I have to pay installments? I said to her, I said, for example, I says, could you come up with $6,000? And this is a senior. Can you come up with $6,000 on April 30th? No. I says, well, that's why you pay installments. So that it's a lighter, like in other words, you may only have to pay $2,000 as opposed to $6,000, but you've already paid previously.
Exactly. And so that we're only talking about 6,000, but sometimes it's literally 20, 30, 40, $50,000.
Mm-hmm.
Now to answer.
Sorry, I was going to say, I know the financial advisors may not necessarily agree with this, but we get OA, old age pension, and we get the CPP, but I have them withhold 80% tax. I get 20%. They have the 80% because at the end of the year, all the other taxes from everything else we've got, and from that, when we take payroll from the corporation, we submit tax on that at the end of the month. But then at the end of the year, I don't have to pay anything. I don't have to think about it. And I know some people would say you should put it into an account and savings. Honestly, it's too much headache. I'd sooner just not have to think about it and make an adjustment.
That is excellent. That is an excellent idea. And so the taxes on your on those income is actually paying the taxes for the rest of your income.
Yes,
which is perfect.
Yeah.
To answer your question, Andrea, or to respond to your comments about putting receipts in a bag, the receipts in a bag work. However, it is more efficient and quicker to just use Excel. Like if all those transactions are from a bank card or debit card and you export those transactions to Excel, it's just so much easier to just look at it on your computer screen rather. Oh, if you also have QuickBooks, then that's great.
So my problem is because the whole like you have to keep your receipts and then you have to because I guess with QuickBooks you should have been able to take the receipt, like take a picture of the receipt as QuickBooks. If you connect all your accounts, it does that. But
yes, it does.
I find like I get so busy, especially with all the events I do, that I'm like, I can't keep up with doing that. So then I'm like, I'm gonna do it at the end or when I have time, which ends up being like at the end.
I'll give you a tip. Those receipts are not really important.
Oh yeah?
They are only important if CRA asks. And so typically those receipts are so small that they're very insignificant, especially if they're stuff like meals and entertainment or office supplies.
Yeah.
Now,
because my line of business, that actually makes up a lot of my receipts, right?
Yeah, exactly. And so with the nature of your business, it's very understandable. Now, if CRA were to ask, like, hey, your travel is higher this year than last year, I want to see what's in that account. If you're using QuickBooks, you can actually just export the travel account and send it to CRA, and that will normally appease them. But if you're using things like Uber or well, actually, it doesn't matter because first of all, those transactions are on your credit card or bank statement. So that's proof that the transaction exists, one. And then two, if it's Uber or taxi or something like that, you can always log into your account and download those transactions from your account, and the receipts are there, and send that to them. So keeping the receipt isn't necessarily it's not really needed unless CRA asks. But we're in a society right now where there's so many online accounts and everything is digital, where all those transactions are on your bank statement anyways. So that's proof of transaction right there. And then if there's an online account, you can just log in and download it. So I wouldn't worry about spending too much time on the receipts because it can be time consuming, and also receipts fade, right?
Yeah.
So that's important. So don't put too much pressure on the receipts.
So you're saying more so just use
your
QuickBooks
bank use your bank or credit card. Yeah. So QuickBooks is great no matter what. You can continue that. But if you use your bank or if you use your bank card or debit card or credit card, the transaction is always in your statement.
Yeah.
So that's the first proof that the transaction exists.
Yeah.
And then if necessary, only if CRA asks, then you can, pull out that statement or log in to get your receipt. But putting all that emphasis on the actual physical receipt isn't really necessary.
So I'm just gonna like paraphrase to make sure I correct. Like, don't worry so much about like matching the receipt to the transaction from my statements. Just worry about like sorting out the sort of transactions to figure out like, all those categories to figure out like all that stuff, right? Is that what you're saying?
Yeah. So continue the bookkeeping. The bookkeeping is extremely important, but the physical receipt isn't really necessary.
Got it.
Can I interrupt? I just
Go ahead.
wondering with regard to stuff that's on expenses that are on your credit card or your bank statement. I would still keep the receipt because CRA may not accept just because it's on your credit card or your bank statement. It's proof that you spend something, but the thing is they want to see physically because, for example, if people want to cheat the government, they could give the receipt to their friend, so they claim it on their taxes, and so does the other person, and so it's double. So this is where you have to be kind of careful on that.
Yeah, the receipts are good, but I wouldn't necessarily spend so much time. It's just I wouldn't spend too much time on it because they're only necessary in the unlikely event that CRA asks for it. But there are a few levels before they get to needing the actual receipt, and even when they do, if you send them the account detail for the year, they will typically they'll go through it and just pick out a few transactions where they want to see the receipt.
Yeah.
And so depending on the type of account, you could just log in and get the receipt. But yeah, so I understand what you're saying, Maureen, but those audits happen. They're not very frequent. So you're kind of balancing time versus being audited. Yeah, I do understand what you're saying.
And
Can I ask you
also,
a question, Andrew? Is with the receipts, if I scan the receipts, will they accept the PDF scan of a
Oh,
receipt?
definitely.
So I can toss once they're scanned, like I can toss the receipt eventually because, like you said, they do fade. So I typically will all my receipts get scanned in regularly so that they're filed away.
Perfect. Yeah. And the great thing about most accounting software right now is that you can attach the digital image to the transaction in the accounting software, so you always have it. And
that was
that's
one of the things I really liked about like the things that have gone on with the newer versions of like the QuickBooks Online, the ability to scan receipts and the ability to use their mileage tracking app to keep track of where we're driving automatically. How does so on the mileage tracking? I just have a question about that. So, so on my mileage tracking, do they want to see the? Because on my I use a program called Mile IQ, and it tracks all my receipt, all my mileage, and I just it's either business or personal. Are they going to want to see the client name because I don't record the client name on my log?
Yeah, so I get these questions a lot, and these audits happen so infrequently that that's why I say I don't spend. I wouldn't recommend that you spend too much time on it. And so, in the unlikely event that they dig that deep, yes, they would want to see, who you met with. But that's even if they go that deep. But on a general level, what they do want to see is either that Mile IQ report or a physical log of every trip that you took and separate it into personal versus business. That's what they want to see. But if you're already using Mile IQ, you're ahead of the game because a very small percentage of people actually do that.
Yeah. Just if you don't know what that is, it's you install an application on your phone, and QuickBooks has one as well. And wherever you drive, it uses the GPS on your phone to create a mile log for you. And it on a weekly basis, I get a reminder to assign those. So I found that very happy. The Mile IQ is free if it's under if depending on the number of drives that you do. Otherwise, I think it's about $10 a month. It's not a lot of money.
Andrew, I was just going to offer one thing. As a business person for the last 30, 40 years, this would drive me crazy. I keep good books, but the thing is, all this stuff, uploading receipts on that, you're just wasting time. As a business owner, you're not, if you're an accountant, if you're a bookkeeper, you love all this stuff. It's brilliant. But if you're a business owner, you're in there in the trenches and you're working, trying to make an income, all this stuff would drive you batty. So
Yeah.
I'd keep that stuff. And if the CRA comes, and so you just wipe off those expenses one time without even dealing with it, it's going to cost you a couple of grand. How much is it going to cost you if you just spend so much time on those little minutiae? So I agree with you, like in terms of the receipts and stuff. Keep copies, put it in your accounting. But if you do get audited now and again, it costs you a few $100s. I've only been audited a couple of times over the years, and most times they're very reasonable. And if there's an error there, you'll meet as long as you're not being out and out just crooked.
Yeah.
You'll arrive at some solution that works out fine, in my experience, anyway. So I just think you can spend so much time on this stuff.
Yeah, like with the receipts, it can be extremely time consuming. That's why I say, you don't necessarily want to put too much time into it. It's just time consuming. But as long as the bookkeeping is in order and that there is at least the transaction is on your credit card or bank statements, proof that it happened. But going as detailed as the receipts, it can be extremely time consuming. And so when people, that's very popular question that I get when people start a business. They focus so much on the recording rather than operating your business. Like if you got into business for consulting or IT or whatever, focus on what you do best and generating that revenue. And you don't necessarily need to put so much time into the recording and the registration of it. Just focus on doing what you do best, which is generating revenue in your field. Yeah.
Good advice.
And work with people like Andrew and Maureen.
Exactly.
Absolutely.
I have a question. About HST. So for a sole proprietor, when they're starting up their business, is it, let's say that they get paid and they're also recouping expenses. Let's say they so let's say they're getting paid for their mileage, or they picked up water for their client or something like that. They're not making revenue on this, they're just recouping expenses. Does that go into their total? Is that looked at income, or is it because it's when people start getting close to that $30,000 mark because they're having a better year than they expected.
Mm-hmm.
So let's say they've been picking up a bunch of supplies for their work, mm-hmm. and part of their, because the owner just issues a check, right?
Yeah.
So how does that, like, they get a check and at the end of the year they're around $30,000 or $31,000, but maybe $3,000 of that was a couple $100 a month for supplies and stuff like that.
I'll give you a scenario to answer your question.
Thank you.
So let's say I'll use your guitars as an example. Let's say you're building a guitar and the guitar costs, let's say $5,000. But you spent $1,000 in supplies that you are just billing back to your customer. So your invoice will have two lines on. One is $5,000 for your labor, and then the second line will be $1,000 for the cost of materials. Now, the second line for the cost of materials is not income. That should go to an expense account because your client is just reimbursing you for it. So on your reports, that second line of $1,000 would not be considered revenue.
Okay, I understand. Thank you. That's a good, that's a nice, simple example. Perfect.
So Andrew has a question. I have a
Yeah,
question about
so Andrea has
intern
another
tax credit.
question, and while she's asking you, Java, if you have a question, put that out there as well. So Andrea, turn your video on so we can see you when you're asking the question. There you go.
So I don't understand about intern tax credit.
Sorry. So like the co-op, like if you have a co-op student and there's
Oh, yes.
credit. So I had an intern last year.
Congrats.
And then I wasn't sure how to like um actually get it. When I asked the school, I was like, I just want to make sure if this intern, are they gonna is it qualified to get this tax credit? And then they weren't sure, and I had to keep following up. I'm like, I just want to make sure, like, they're like, yeah, okay, we'll provide the letter that you need or whatever. Now I actually have a call later with my accountant, but I tried to ask him through email, like, so am I gonna get it? And he said, well, did you put them on payroll before, in order to receive that? Which when I was going on the website on CRA, I don't remember it saying like this
So are you referring to the summer jobs grant or Canada Summer Jobs Grants?
I can give you the specific link, but there's basically this like cooperative
So
program tax credit.
So I'm very familiar with the Canada Summer Jobs Grants. And for that, yes, I'm assuming that most of them or all of them, especially ones that are funded by the government, yes, you need to put them on payroll. You need to calculate their pay stubs with their gross CPP, EI, and taxes in order to get that grant. Because at the end of the summer, at the end of the period, you're actually going to submit that report to them and say, hey, I spent X amount of dollars on payroll, and they will reimburse you for a large chunk of that. So in normal situations, yes, you must put them on payroll and calculate CPP, EI, taxes, et cetera, and give them a T4 at the end of the year.
And for subcontractors, like
For subcontractors, you
have to
should
give
be
them a
giving them a
T4
T4A.
And how do you like calculate that stuff? Like, does your accountant do that? Like,
There is no calculation for a T4A. If you paid them $20,000 for the year, it's just $20,000 on line 48 of their T4A without any deductions at all. So T4A is actually easier because there's no calculation.
but is that something like your accountant will do, or you have to like do that yourself?
Well, the accountant should do it for you. Like they'll actually file it with CRA.
I meant like I have to issue the T4A for the contractors working for me. Like I'm saying,
Yes.
do I have to like learn to do that, or like my accountant should be?
Your accountant should be doing it for you, and if they don't, they should be advising you that you need to do it. But it's something that they should be doing. And the deadline for that was the end of February, if you haven't done it yet.
Whoops.
Backdate if possible. No,
So
Andrew.
for T4As, it's not that big of a deal if you miss it, to be honest with you, as long as the subcontractor claims it on their taxes. So T4As is not a big deal if you miss it, but T4s definitely. It is a big problem, and they will be.
T4A is the subcontractor one.
Correct.
Okay.
Dave, you had a question?
Well, no, just to add to what Andrea is asking. So if she has someone working for the whole year on and off, she basically need to document that as an employee?
Yes. Well, it depends on the type of relationship, because there can be a subcontractor relationship or an employee relationship.
So I think the distinction from the learning here is like, yeah, I think it's like treating them as a subcontractor versus an employee, and especially with like the intern thing, I think that's maybe where I messed up, where I didn't put them on a payroll.
Yeah, so if they are an intern from a school or Canada Summer Jobs Grant, and you're applying for that tax credit, then yes, they must be on payroll. So without them being on payroll, you most likely will not get that tax credit or that grant or whatever.
Right. But I can still, obviously, it's a taxable expense kind of thing.
Yeah, it's still a tax deductible expense for sure. Yes, but you're just not going to get that money back.
That's gotta suck.
Yeah, it sucks.
Learning for next year.
Yeah. So when it comes to payroll, I recommend WagePoint. WagePoint is extremely easy to use, and the one thing that I love most about it is that it will deduct the payroll taxes for you and send it to the government for you. So it won't be an extra step for you. For QuickBooks payroll, it's an extra step that you have to do, but with WagePoint, they do it automatically for you. So it's one less thing to worry about.
What's the
You write
maximum you can get back?
It depends on the grants that you're applying for. With Canada Summer Jobs Grants, CRA will, or Canada will give you up to minimum wage for, I think, 4 months.
And it's not something you can like backtrack, right?
No, so I know that there are many programs, but I'm very familiar with the Canada Summer Jobs Grant, and the deadline for that is in January every year. So you really have to apply for it in January, and yeah, you apply for it in January, and then you hire in hopes that you will get the Canada Summer Jobs Grant. Yeah, so there are many programs out there, but typically, yes, you need to put your employee on payroll to take advantage of it.
I know that the government had the digital adoption program, and they would give you up to $7,500 credit towards an employee as long as they met certain conditions. They had graduated within 3 years, and they had a specific job and role that they were doing towards your quote unquote digital adoption, right? So there was, many ways of making positions fit that if they were doing like maybe starting up your social media, et cetera, et cetera.
Mm-hmm.
So it's a matter of sitting down and looking at the various grants and credit programs that are available, and then strategically figuring out how to apply that to your business. And then Andrew would be able to advise you whether he thought that was made sense or not.
Yeah.
True. Any other questions from anyone else? Jav? I know Ro doesn't have any question. Rochelle? Luz, any question for you? Just wanted to make sure I don't leave out these guys. Okay, so this is what we're gonna do. Well, let's talk about this first, and then we'll turn the cameras off so we can be more frank if we need to be. So there's a 25% tariff that's imposed on us right now from the United States. How are we better able to weather the storm from the accounting perspective? Is it just by organizing our books better, or is there actually things that we can do?
Well, looking at who's in the room right now, I think Jeff, you may be most affected by it, if at all, because you're the only one involved in physical products. So if you're shipping anything to the US, or purchasing in bulk from the US, you're definitely going to be affected. And so I guess the question is, how can you weather the storm? At this point, I'm not sure you can, unless you are buying in bulk and then going over and picking things up and then smuggling it across the border. So I've actually heard of that. But really, so what I've heard a lot of businesses are doing is they stocked up. They bought in bulk prior to the tariffs going into effect, and just hoping that they can have enough product to wait out the tariffs. That's one thing, but at this point, it's kind of late for that. But yeah, if anything physical is going across the border, there's not much you can do. Now, it's also very possible that depending on how you're doing it, like if you're shipping, I don't know, a box of strings or something from the US in bulk, it's very possible that they may just slip under the radar, because I really don't know how these things work, but I imagine it's like they can't track everything. definitely you can't hide a truck shipment going across the border, but definitely, or maybe anything traveling, like if you order something online through UPS and comes in a big box, that may not be taxed. I don't know. So there's a
Yeah,
lot of uncertainty about
yeah.
that.
So my experience is anything that is shipped by a commercial carrier like FedEx, DHL, Purolator, um, when they're the exporter, they have to fill out the harmonized sales tax code, and
Mm,
therefore then the tax is calculated right there. And I have a import broker that deals with that.
mm,
So if it comes through Surface Post and it's from a smaller seller, sometimes these things, as you're saying, Andrew, slip through. So if you order things, let's say from online services and they ship via post, um, the taxes may not be quote unquote collected.
yeah.
But my experience is that everything that comes through commercial carriers, because it's an international export, the paperwork is filled and you do pay that. So, we will see that. And I mean, I've been dealing with importing and exporting goods for the past 30 years, and even though we may not have seen tariffs, when we get into the exchange rates where it's like 40, 45% exchange, that's almost a tariff, if you will, especially
Mm,
like if you think about a year ago, a year and a half ago, when we were closer to par on exchange, maybe that's 2 years or 3 years ago now. But and then we see that, so it's like we have to adjust our pricing based on that so that we can maintain our margins. That's been my experience. So the big thing is that hopefully this too shall pass, and as the American people realize that this is impacting
mhm.
their their cost of living, they're going to not want to participate in this either, because
Yeah.
tariffs are tariffs are not good for either side of the.
I do understand why he's doing it, but if things work out the way he wants it to, there's going to be a lot of pain in the meantime.
Absolutely. Yeah.
Yeah, even if things work out, there's going to be a lot of pain.
All right, so let's stop the tariff now. We're gonna stop the recording. So if you need to be a little more frank, you can be.